Hi, my name's Josh Mahoney, Chief Market Analyst at Scope Markets. Let's look at the week ahead from an earnings perspective for the week starting Monday, the 29th of July. And certainly this is going to be a week to remember. It comes off the back of the second most busy week for Q2 earnings, where we saw, of course, a tech-led sell-off, primarily laying at the foot of Tesla and Alphabet. And that comes despite the fact that largely the Alphabet earnings were strong. We saw a bit of weakness in terms of the network business, and we also saw a bit of weakness in terms of the YouTube ads side of the business. But by and large, the rest of it did well. They beat on the top and bottom line. But markets in rather unforgiving mood at the moment. And that provides significant question marks for the week ahead, where we see roughly a third of the S&P 500 reporting, and we see 4 out of the 7 so-called Magnificent Seven also reporting over that period. So it's going to be massive in terms of earnings season, and it should give us the basis for understanding the trajectory of earnings for Q2. So let's move through the data. We've got a lot to get through today. First and foremost, this is where we stand so far in terms of earnings. 32% of the S&P 500 having reported thus far. The outperformer you can see here, healthcare, 25% of the sector haven't reported, but you can see 94% of them have beat on earnings, 81% have beat on revenues. In terms of the areas of weakness, utilities, I would say, and energy particularly, but energy coming in focus in the week ahead, as we have ExxonMobil and Chevron both reporting for this coming week. Also, if we're looking for the busiest, you can see here 65% of the financials now having reported, with 84% of them beating on earnings and 57% beating on revenues. Like I said, this coming week marks the busiest of the Q2 earnings season, and it comes off the back of the second busiest. You can see by and large between the 2 weeks, you can see the vast majority of the S&P 500 reporting. So you can see why this week ahead is going to be so notable. And we're coming off the back of a tech-led sell-off where it feels like the weakness for Alphabet in particular has essentially just been transmitted across tech as a whole. So let's hope that the week ahead can allay those fears and instead put us back on a positive track. But certainly plenty of big earnings for traders to either sink their teeth into and trade around the volatility, or avoid. It depends on the way that you play it. So in terms of the results so far, we've also seen in terms of positive or negative surprises versus expectations. You can see outperformance here for revenues in terms of materials, consumer discretionary, and financials. And then you can see weakness in terms of energy on the revenue side of things. In terms of earnings, you can see overwhelmingly geared towards positive surprises, and that is most notably focused on the consumer discretionary and materials and financials sectors. So let's get into it. First and foremost, this is the expectation on an annual basis for Microsoft. It gives you a good idea by looking at things on this sort of year-on-year basis. It gives you a good idea of the trajectory in the past and also the expected trajectory going forward. Sometimes when you look at trajectory going forward and saying, wow, you know, this company is going to double or triple its revenues or earnings over the next few years, you could say this is going to be a great stock to be in. But also the flip side of that is that's often what markets are pricing in. So do they have too high a bar for the earnings seasons ahead that they have to achieve, essentially? And if they don't, then markets will, of course, be disappointed. You can see here the expectation for Microsoft is that by 2027, we'll be seeing EPS around 18.84, currently at 9.81. So a doubling of the current EPS expected over the next 4 years. You can see in terms of the revenue side of things, this time around 244 expected from 212, expected to go up to 378 by 2027. So very healthy clip expected across both earnings and revenues. In terms of the quarterlies, though, we're expecting 293 on the Q4 earnings per share figure. That is a touch lower than a Q3 figure from last quarter. But if we look on an annual sort of year-on-year basis, you're looking at 269 last time around. So improvement in terms of earnings per share on the year-on-year basis. and improvements on both a year-on-year basis and a quarter-on-quarter basis for revenues, with 64.41 expected. In terms of the breakdown for where they earn their money, you can see that they have progressively been moving towards the cloud side of the business. It's the cloud absorbed product, which is right, but things up in terms of returns over recent quarters. So that's the area that people are going to predominantly be looking towards, and cloud and services side of the business really does have strong margins. You can see that bottom side of things, where you're looking at, say, Windows and Xbox, the operating margin much smaller at 25%, but you're looking at 48% on the side of the business, and you can see the Microsoft 365 and LinkedIn side of thing, 53%. So very strong margins on those top two segments. That's why they're expected to continue to try and push growth in those regions. In terms of strong expectations perspective, you can see that overwhelmingly positive, 21 strong buys, 34 buys. In terms of the most recent updates from analysts, the targets are overwhelmingly positive. The last 6, I believe, I've put on here, positive targets in the double digits: 16, 22, 21. 39, 13, and 16. So markets certainly analysts out in terms of Wall Street, do we continue to retain a strict belief in this stock? And that is a good thing, but it's not necessarily expected, because we're talking about a company that has been a very strong performer over the years. From now, we can see the pullback recently taking us back through the 61.8 at the moment, 425 as we trade. This is Thursday that I'm making this video. The time frame shows you a very clear trend that has been playing out, and the monthly time frame shows you a similar kind of thing, right? You get a month of downside, sometimes a few months, but the trend has been very bullish post-COVID, right? Of course, we had that protracted COVID that we saw for most stocks, but you can see the we're seeing at the moment very strong. You can see the last time that we saw that was here in April. Notably around earnings season. Once again, we can see that if we look at things in terms of earnings, let's just go back. You can see here that we saw this big pullback into earnings and essentially mark the bottom for the likes of Microsoft. So we've seen a pullback coming into earnings, and this is from coming down to the fact that markets essentially, as soon as we get into earnings, we think, oh, the walls are going to fall off, and suddenly we're going to get earnings. The valuations are not going to be justified each time. I mean, we can see at the bottom these areas, the fact that they're green shows that they've outperformed expectations on each occasion here. And so we're talking about a company that is a very strong performer, and the point that we're saying at the moment, if you look at what's happened in the past, those pullbacks into earnings can often provide opportunities for growth. Certainly, if we see a strong earnings report, you need to run the risk of jumping in on the hope that we're going to see strong earnings and doing so beforehand. If we look at how things behaved this time, we saw a pullback. So the earnings report hit it. We still back upwards, and then pull back. And so you take things and you take the risk of the uncertainty. Actually, that was actually somewhat we can categorize before, and then that at the bottom. So it's not to say that if we see strong things that suddenly we're going to see this stock back up to 470. It takes time. We're talking about a significant size of funds needed to go into this stock to be able to get it back up. You're talking about $3 trillion companies here. So, if we don't see strong earnings coming up, we'll still see some jitters around the market anyway, because we're seeing this is the first to report out of the Mag 7 names of the week. So this is on the Tuesday, I believe, and the other two that I'm going to highlight are on Thursday. So we're still going to see some jitters around the tech sector. But if we do see another strong earnings report, I think the point that we're seeing at the moment is probably not justified, and hopefully this will form the basis of the trend continuing. We might see a break through that 304 support level to negate the trend and point towards a wider pullback for this company. Next, we want to bring up, so we can see here in terms of the sort of year-on-year performance expectation, we haven't seen a huge amount of movement over the last couple of years in particular. You can see 611, 613. Expectation will push inwards and upwards over the next few years, 662, 729, 807. And in terms of revenues, 388, 416, 433. So gradually over the coming years, that's the expectation. This company has been struggling somewhat. You can see a decline in 2023 compared to 2022. In part, this is down to the weakness of the Chinese consumer. And there's hope, as we've just seen over the course of the week just gone, we've seen further interest rate cuts in China. There's a hope that the Chinese will try to start a fresh of consumption. It's difficult, and we've also got the concerns around what might happen if we see a breakdown in relations between the US and China if Trump comes into power. In terms of the quarterly, 134 expected on the EPS figure, that's down from 153. And if you look at the quarter on looking back to Q3, 126 last time around, 134 this time around, and this is a highly cyclical stock, which I'll get into in a sec. 84 expected on the Q3 revenue side of things, and you can see last time it was 81.8. So trajectory, but not necessarily hugely so. We can see this is where the revenues come from. iPhone, the number one product really, and it remains so. Over half of the revenues coming from the iPhone, and that's why we see very cyclical income. Of the business revenues coming from services, and that is going to likely play a bigger role as we go forward, as they try to build out these revenues from services much more reliable. And we can see that here, that's the key cyclical nature of iPhone sales. As we wait for the next iPhone to come out, everyone goes crazy, and then that just dies down as we wait for the next one to come around. You can see that orange segment at the bottom of the services segment growing as we go forward, and much less cyclical by nature, much lower cost as well, of course. Services, digital services take a lot less effort, a lot less factories and workers and moving parts and transportation to wherever. So the services, the growth of the services business will be absolutely key here. In terms of expectations, you can see the analysts, Wall Street with 12 strong buys, 21 buys. The recent price predictions are all already 9% above where we were 25, 21, but then prior to that, a couple pretty significant inside projections, 22%, but also 170 and 187 from two analysts. So next here, in it's probably due to the fact that we're talking about a company that is heavily reliant on physical goods, heavily reliant on the Chinese market. And that's not necessarily something that is super reliable at the moment. We're hoping to see a rebound in terms of China, but whether that comes into the fore remains to be seen. They are sort of at least starting to make the right moves over in China in terms of monetary policy. In terms of the share price, we can see here that pullback recently has taken us down through that 61.8. That's the same kind of thing that we saw from Microsoft. Through the 61.8, heading towards just 76.4. That is here at 213.8. The trend, of course, is bullish, but we're coming off the back of a strong surge in the share price. So we're putting into a regular retracement, or whether we're coming into this near-term retracement, that's something we need to gauge, and we need to see it go through that 206 mark to give me confidence that we are coming into the wider pullback, which is going to come down to this earnings season, right? And I'm going to manage to put it out the bag. There's still big question marks around the Chinese consumer in particular, but we need to see strength in terms of the services side of the business as well. So looking at the midterm support, we'll be looking here at 213, which is your 76.4 fib, and ultimately 206. If we break the 206, then the look like they could be in charge for a bit longer as we look for that wider retracement to come into play. Until that happens, the bullish pattern still is playing out. We're seeing deep pullback below the 61.8 fib and potentially towards that 76.4 as we try to gauge whether the sell-off is justified or not. Bearing in mind, the sell-off is predominantly being driven by Forex earnings, which were strong for the most part. In terms of the thing we want to look at for it is the likes of Amazon. We can see here that the Amazon expectation in terms of earnings is absolutely outstanding. You can see here earnings per share from 2023 to 2.9 years. You can see the expectation for 2027, 8.69. So we're expecting to see massive upside in terms of earnings over the coming years. That's not necessarily just driven by revenues, because you can see here it constantly falls the 2023 figure and 2027's 860. So in terms of sort of percentage terms, they're completely happening. It points towards growth in the high margin side of the business, so to speak. Now, we'll get into that in a second. We'll just show us what the outlook is for the quarterly figure. So we're expected that's up from 0.65 in the same quarter last year. So really significant growth on the earnings side of things for the quarterly basis. And then in terms of the revenues figure, 148.65, that's up from 134.38 the same period last year. In terms of where the revenues come from, you can see only in favor of online stores, so the traditional business of Amazon, 40% of their revenues, but it's down from 50% in 2020. So where is that sort of growth coming from? The growth isn't necessarily coming from online stores. The growth is instead coming from the mix of AWS, which Amazon Web Services, their cloud product, which is absolutely massive and growing. You can see that that was just 12%, now up to 16% of revenues. Third-party seller services also seeing significant growth on that side, and also really strong growth here in terms of advertising services. So the services side of the business is absolutely key. I move away from physical and towards the digital. We're able to really hammer home the margins and gain really strong margins, lower costs. So that's really the area that we're going to be following, in particular for this coming announcements. In terms of Wall Street, we can see here 17 strong buys, 43 buys in terms of Wall Street analysts. The projections are pretty much in favor of upside, 27%, 18%. We've got one that's predicting the BNP that the price target is essentially flat. And then we've got 32% above, 21, 26. So predicting further upside, and you can see that price target, the mean is 25% above where we are at the moment. We've seen a significant pullback in the share price in line with what's been seen within the wider markets. And we'll show you exactly that here. Let's just go on to the daily time frame. We can see that the pullback has taken us down through the 76.4 Fibonacci level. That threatens the uptrend that has been dominating the past year. And quite frankly, because you can see the lows in 2023, we had sort of the COVID sell-off and everything like that. We saw that recovery into record highs not so long ago. We're seeing this pullback at the moment as people are concerned about what's happening in terms of the US consumer in particular. The key thing here is doing 173.87. If we, there's a good chance we do see the bills coming back into place soon. And of course, we have got concerns around the US consumers. We've got these elevated interest rates. I've just seen these are coming out of the US. We saw better than expected core durable goods. We saw better than expected GDP data. We've seen initial and continuing jobless claims. In terms of the economy, we're also seeing the Just from a quality perspective, because I'm recording this on Thursday, expected towards things that should give us confidence, because if we see inflation declining, then we're likely to see the Federal Reserve cutting interest rates. And if we're seeing a stronger economy, we don't necessarily need to worry too much in terms of the US consumer. And at the moment, we're going through the 76.5, from 73, well, that's when it's time to get worried. But until that happens, the bullish trend still remains in play. As that 189 swing high would be the level that, if broken, would essentially negate this current pullback. But I think personally, I don't think we're going to break the 173. If we do, that points to a wider sell-off. But look, what do I know? It really comes down to exactly how these earnings are going to come out. If we look at the trajectory following the recent earnings reports, let's just go into the daily time frame just to give you a view here. So you can see this pullback here, largely over around that earnings season. You can see a similar kind of, well, not similar, but this was within an uptrend, and we saw that gap high and it continued in that vein. You can see this earnings season here essentially ended the selling pressure and we marked a bottom. So are we going to see something similar here for Amazon? Well, that's going to be what we're going to be looking out for, and hopefully we will see that. And as we have seen in the past, these earnings reports can essentially mark the end of a sell-off for these big tech names. And there is a hope that we'll see something similar on this occasion. If we break that 173 mark, that's when it's maybe time to become a little bit more concerned about the whole buy the dip mentality. But at the moment, the dip may not necessarily be justified. And certainly with the biggest week for earnings for the second quarter ahead of us, we've got plenty of volatility ahead for traders to sink their teeth into.